Afternoon, students. Today we'll be looking at your long-term assets and also your current assets and just discussing sort of how we actually think about the assets section in your statement of financial position or your balance sheet. The first thing we want to do is classify your assets into current and non-current assets. The non-current assets actually reflect your longer-term assets. If you expect an asset to be long-lived or to last your business quite a long period of time, it's a resource that you can continue to use for a long period of time, we want to classify that asset as a non-current asset. This includes assets like PPE, which is property, plant, and equipment, and intangible assets. Your intangible assets don't have a physical substance. These include patents, any trademarks, licenses that you can include as part of your intangible assets, where you can see a benefit will come, but it's not in terms of a physical asset. When you're actually looking at the property, plant, and equipment and intangible assets, we actually expect these to last over a long period of time, but we want to reflect the usage in your income statement. As and when you use these long-term assets, you will reflect the usage in the income statement through an account called depreciation, or for intangible assets, the usage will be reflected as amortization. Please be careful not to confuse depreciation and amortization, which both reflect usage, and confuse that with an impairment. An impairment, for instance, is only when an asset becomes obsolete before it is fully depreciated. In that instance, if it loses a lot of value due to an exceptional circumstance, you need to write off that asset in your income statement, and that is the process that we refer to as an impairment. Please distinguish between depreciation and amortization, which are use, an impairment, which is an exceptional circumstance. Either we got hail damage, either your car got crashed, either your machine got ruined by an exceptional circumstance. When that happens, you need to reflect a once-off impairment in the income statement. How do we classify your assets into non-current and current assets? The quickest way of thinking about it is thinking about which assets are going to be used in the normal operating cycle of a business or within the next year. If it's going to be used in the normal operating cycle, for instance, inventory, you keep getting it in the normal operating cycle and you're expecting to sell that inventory within the operating cycle of the business, you will then classify all these assets as current assets. These current assets, for example, are referred to as either cash and cash equivalents. You can have this under your current assets section. You can either have accounts receivables or trade and other receivables. And also then your inventory balance will be reflected as current. Assets that are then not intended to be turned into cash quickly or within a year are then classified as your non-current assets. You can have fixed assets within this section, which also include property, plant, and equipment, machinery, any delivery vans, any investments that you have, and your non-intangible and your intangible assets in this section. The quickest way of looking at it is through this tree diagram. So the first question you need to ask yourself is this asset or the purchase of this asset going to be long-lived? If it's not going to be long-lived, what is the point of then creating an asset and then having to expense it? In that instance, we can immediately expense that item. If I were to think of an example, I would think of a university. Let's say a university goes and buys out chalk for their blackboards. In that instance, if they expect the chalk to be used up fairly quickly within the next 2 months, there's no point in creating an asset for the chalk in the balance sheet and then reclassifying it out as an expense the minute it's used up. The minute we know that we've acquired chalk and we know it's short-lived, we can expense it immediately. But one needs to think that everything we've actually purchased actually is an asset, a resource that we control, and it quickly becomes an expense only once we use it. The second question we need to ask is the asset tangible in nature? So does it have any physical substance? If not, immediately it's an intangible asset, and the use will be reflected, as I said, as amortization. If it is tangible, we need to ask, is it going to be used in a productive purpose? If it is, it then gets classified as property, plant, and equipment. If not, an investment. Now, the question is, yes, we know how to classify it, but what amount do we classify then this asset at? The amount you classify the asset at is any costs that were related to the acquisition of that asset. So if I put an example here on Excel on the right, let's assume I purchased a machine on the 1st of July. Let's make it 2020. I purchased this machine for $30,000, but I also incurred $2,000 for insurance and another $5,000 for transport. Because the insurance and my transport costs were incurred in getting my machine to a place where I wanted to use it and getting it ready for me to use, I can then include that additional $7,000 in the cost or the capitalization of my asset in my balance sheet. So what I want to recognize my asset at is not just at the $30,000 and expense the $7,000. I can recognize my full asset, my full resource at the full $37,000 in the balance sheet. That $37,000 reflects all the initial costs, which include transportation, insurance, setup costs, and legal costs. The reason why I'm allowed to expense that is because had I not actually incurred those costs, I would not be able to use the machine in the way that I intended to use it for my business. Now let's touch on the usage of my asset, this machine. The usage of your asset also needs to take into account what is called your salvage value. Okay, when you look at salvage value, it's the exact same thing as residual value or scrap value. The salvage value represents the amount or the value from this asset that you can get at the end of the useful life. So let's say in my machine example, I expect my machine to last for 5 years. And at the end of the 5 years, I still think I can scrap it or get rid of it for a value of $7,000 even after the 5 years usage. In that instance, I will then take into account what I've labeled here as RV as the residual value of $7,000. In that case, my depreciable cost is not just the full $37,000. My depreciable cost becomes $30,000. How you calculate that is you just take the cost, which includes, remember, all the insurance and transport costs, and you subtract the residual value. This is the amount that you will be depreciating the asset by using your useful life. Okay, what happens in this instance is if we had purchased this asset though on the 1st of July 2020, and let's assume our year end was from 1st of Jan to 31 December, so our year end is 31 December, so it runs that full year, but I only purchased this asset in July. In that instance, I only need to show that even though my depreciation per year, if I divide it by the 5 years, would be $6,000, I need to reflect only the usage for that year. And in this instance, for that specific year, because I purchased it in July, my usage would only be the $3,000 in 2020. So in 2020, I then have usage of 3, and for all the other years, I'll have 6, but that last year, I have another 3. And if I then go and take my initial cost that I capitalized of $37,000 and subtract all the years' depreciation over this entire period that I had used it, my asset needs to get me back to that exact same residual value which I had, which I expect to scrap it at that value. So bear in mind that your residual value you subtracted from your initial cost to get to the depreciable cost, and then at the end of your balance sheet, after you've used it for that number of years, that 7,000 will be reflected at the end of your balance sheet. Let me take you through a few examples of where we also look at the few different types of depreciation methods. The first depreciation method we'll be covering is just the simple method called a straight line method. The straight line method is very easy because it allocates an equal amount to the depreciable cost each year you use the asset. So this machine example that I used, because I used a machine for 5 years and I'm using 6,000 per year, this actually is the straight line method. So your straight line method is actually a simplified method because it produces a constant depreciation expense. And a lot of companies actually are using this method just to have a simplified depreciation method for people to understand. Let's look at the example covered on the slides. Little King, you purchased a truck for 40,000 and the truck has a 5-year useful life and a 5,000 residual value. What will be the depreciation expense each year? What you start off with to calculate the depreciable cost is you need to take into consideration this initial cost of 40,000, subtract your 5,000 residual value. My depreciable cost in this instance, in this Little King example, will only be 35,000 and not 45,000. And if we're depreciating the machine by 5 years, if we look at here the schedule, you'll have start off with 40, but your depreciable cost is only 35,000 in that instance. You divide each year by 5. Your depreciation expense will be 7,000 every single year. As you can see here, it's a constant depreciation expense. And as we keep subtracting this depreciation, we get to a book value. Your book value, or what is called your carrying value, represents your initial cost less your depreciation. Okay? And as your depreciation happens every single year, you've also got what is called accumulated depreciation. Your accumulated depreciation, which will also be reflected in your balance sheet, will just be all the depreciation over all the years. So in year 2, because you've depreciated by an extra 7,000 and in year 1 you had another 7,000, your accumulated depreciation will reflect 14,000. And this accumulated depreciation increases over time each time you add the depreciation expense for that year. You'll notice here for the straight line method that your depreciation, your book value, will be the residual value at the end, which will be the 5,000 value here at the end. The second method that we're going to be looking at is the declining reducing balance. So the same example here of 40,000 with the 5,000 residual value. However, the estimated depreciation is 40%. What we're trying to do with the declining balance is have a higher depreciation expense in the early years and reduce this and make it smaller and smaller over time. So in this instance, what we look at, each time you depreciate the book value, you don't go and use the depreciable cost here. You actually times your depreciation rate by your beginning book value, which is your end value here. So you take that end value and you'll notice here in this instance, your depreciation each year gets smaller and smaller to reflect then the 5,000 residual value at the end. I will then cover the activity depreciation and the liabilities in the next session.